Welcome to the Deep Dive, your go-to source for really getting into the important details from the latest information releases.
That's right.
Today, we are taking a deep dive into RE/MAX Holdings' second quarter 2025 earnings call. We're not just going to, list the numbers. We want to dissect management strategy, unpack how the market reacted, and try to figure out what it all really means for RE/MAX.
Yeah, they're in a challenging spot, but maybe things are shifting a little.
Could be.
And you're right, this quarter for RE/MAX wasn't straightforward at all. Definitely some mixed signals in their results.
And the market's reaction told a story, too.
It sure did. So our mission today is to cut through that noise, look at the nuances, and understand the strategic moves RE/MAX is making. It's a complex housing environment out there.
Okay, let's jump right in. Headline numbers for Q2 2025.
Let's do it.
RE/MAX Holdings reported a GAAP EPS of $0.23
Okay.
and a non-GAAP or adjusted EPS of $0.39. Now, on the face of it, both those numbers beat the consensus estimates pretty comfortably.
Right, which, seems like a clear win.
Yeah.
Beat the street on earnings.
Yeah.
That often gets a positive reaction.
Often, yeah.
But
yeah.
The revenue picture was, a bit different. Maybe more concerning for some investors. That seemed to be the focus.
Okay, what was the number?
Total revenue for the quarter came in at $72.8 million.
And that was that.
That actually missed analyst expectations slightly. And maybe more importantly, it was a 7.3% decrease compared to last year.
Oof, okay.
Yeah. And the market's reaction was pretty immediate and pretty sharp. The stock dropped 8.69% on the day of the call.
Wow.
And trading volume spiked too. So it tells you loud and clear, the earnings beat was nice, but investors were really zeroed in on that revenue miss. What does it mean for growth?
It's that classic tension, isn't it? Earnings versus revenue.
Exactly.
But looking for positives, the company's adjusted EBITDA hit $26.3 million. That gave them a pretty healthy margin of 36.1%.
And that margin was actually up.
Right. A 30 basis point increase year over year. That's a 0.3% better margin. It really shows they're managing expenses well.
Definitely speaks to cost control.
Plus, that recurring revenue stream, it stayed strong. 67.3% of total revenue if you exclude the marketing funds.
And that recurring piece is important, right? It shows the stickiness of their model, even when the market's tough.
Exactly.
And this margin expansion, it's a key point because it's not just a one-off thing.
No.
Management really hammered this home. It's been 5 consecutive quarters now of improved margins.
Led quarters, okay.
To put it down to ongoing operational efficiencies, disciplined spending, the takeaway is clear. When your top line is pressured, you have to control costs to stay profitable.
Squeezing more out of every dollar. Makes sense.
It's crucial. Testament to their internal discipline, really.
Okay, now here's where I thought it got really interesting. The agent network.
Ah, yes.
Yeah?
The agents. Always key for RE/MAX.
They hit an all-time high global agent count. 147,073 agents.
Wow, all-time high.
Yeah, that's up 2.5% year over year. And the growth is really coming from outside the U.S. and Canada.
International growth strong, though.
Very strong, up 11.5% year over year internationally. That's a huge network effect playing out globally, expanding their reach significantly.
Okay, that's the good news on agents.
Yeah.
But U.S. and Canada.
Right. While global expansion is booming, the U.S. and Canada agent count actually saw a 5.0% decline year over year.
Okay, so that raises the question, doesn't it? What's happening in their core, most established markets?
Management addressed it. They acknowledged the decline, but said they're seeing signs of stabilization in the U.S. count.
Stabilization how?
They said Q2 2025 was actually their best U.S. agent count performance since way back in Q2 2022.
Okay, so improvement from the recent trend.
Seems like it. They even pointed out April was their strongest month for U.S. agent count in 3 years, and recruitment rates in May and June were higher than the same time last year.
So it's a real mixed picture. Big global growth, some core market decline, but maybe, just maybe, the U.S. decline is bottoming out.
That seems to be the narrative they're pushing. It's like a strategic balancing act.
Yeah, it is.
So tying it together, what's the big picture insight here? It feels like RE/MAX is juggling, they're being disciplined financially, you see that in the margins, but also pushing strategic growth.
Bifurcated growth, almost.
Yeah, expanding globally, trying new things with tech for agents, even if near-term revenue in the U.S. and Canada faces headwinds. It's like a bet on the future value of that network.
Right, investing now, even if it pressures the top line a bit, which leads us nicely into those strategic initiatives they talked about.
Exactly. What are they actually doing to add value and drive that future growth?
Well, the Aspire onboarding program, launched back in April, seems like a big one.
Tell me about that.
It's not just, basic training. They described it as innovative, combines education, tech, and apparently a unique financial model aimed at newer agents.
And is it working?
Seems like it's getting traction. Nearly 60% of U.S. and Canada brokerages have signed up already.
60%, wow.
And management directly linked it to those higher U.S. recruitment rates we just talked about. So early positive signs there.
Okay, interesting. What else on the tech front?
They also unveiled an AI-powered global referral system in Q2.
AI referrals, how does that work?
It's a real-time data platform. The idea is to make it easier to send and receive referrals across their huge global network over 110 countries.
So connecting agents across borders seamlessly.
That's the goal.
Yeah.
Simplify and scale referrals. And they also mentioned their lead concierge service is still going, connecting consumers to agents, trying to convert leads, building out that value prop.
Okay, so Aspire seems to be doing well. How about the other new stuff?
Well, that's where it gets a bit mixed again. The RE/MAX Media Network, another initiative they sounded hopeful about.
Yeah.
It's seen a slower ramp-up than they expected.
Why's that?
Management blamed the challenging macro environment, mostly, saying it's impacting advertising spend from partners.
So one new thing helps agent growth. Another new revenue stream gets slowed by the economy. Highlights those external pressures.
Exactly. It's not all within their control.
And speaking of those pressures, what was management's tone on the overall market?
They use the phrase cautiously optimistic.
Ah, the classic.
Right. They acknowledge the headwinds. High mortgage rates are still biting. Affordability is a major issue. Existing home sales are sluggish.
Plus general uncertainty.
Yeah. Tariffs, inflation worries, consumer confidence. It's a tough backdrop. Makes their internal execution on costs even more important.
But cautiously optimistic implies some optimism, too. Where did they see that?
They pointed to some green shoots, as they call them.
Green shoots? Like what?
Well, the June RE/MAX National Housing Report showed inventory levels up quite a bit, 30% year over year.
Oh, okay. More houses for sale.
And new listings have grown year over year for 16 months straight now.
16 months. So there's some activity underneath, potential for recovery maybe.
That's the hope. It provides that balance to the caution.
Yeah.
Suggests the supply side might be easing up, which is key for transactions down the line.
Got it. And then there were some big moves after the quarter ended too, right?
Yes, significant strategic stuff. The conversion of a big brokerage in Hawaii
Hawaii, tell me more.
brought 170 agents and 6 offices into the fold, branded as RE/MAX Hawaii, starting August 1st. Expected to really boost market share there.
Key market, high value. Makes sense.
And then there was a key appointment. Vic Lombardo is now president of mortgage services, effective August 18th. He's leading Motto Mortgage and Wemlo.
So a renewed push on the mortgage side.
Clearly aimed at speeding up that cross-brand monetization, getting more value out of the mortgage services arm, filling a leadership gap there.
Okay, so connecting all these dots, the results, the initiatives, the market context, what does their outlook look like? The guidance.
Right. The guidance reflects all this. For Q3, they're projecting agent count to increase 1% to 2% year over year.
Okay, continued growth there.
Revenue between $71 and $76 million. And adjusted EBITDA, $23.5 to $26.5 million. Pretty tight ranges for the near term.
But the full year guidance, didn't that get adjusted?
It did. Some notable tightening there. Revenue for the years is now expected between $290 and $296 million.
Down from
the previous range of $290 to $310 million. So they basically lopped off the top end.
Okay. And EBITDA.
Tightened to
Yeah.
now $90 to $95 million from $90 to $100 million previously. Again, narrowing the range downwards.
And that tightening definitely caught the market's attention.
For sure. It raises the question, why tighten? Especially if you're seeing green shoots.
Yeah, what was the reason?
Management mainly pointed to that slower ramp-up of the newer initiatives, especially the RE/MAX Media Network.
The ad spend issue again.
Right. Also, a more cautious outlook on broker fees. And interestingly, some near-term revenue pressure from the Aspire program itself as it scales.
Wait, Aspire is hitting revenue, even though it's helping recruitment.
Yes, because apparently the financial model for newer agents in that program means sort of less immediate revenue for RE/MAX, even as it brings more agents in.
So it's a trade-off, long-term network growth versus near-term revenue impact.
Exactly. You invest in bringing agents on board with maybe more favorable terms initially, hoping they become productive long-term members of the network.
Interesting dynamic. But amidst that tightening, they actually raised the agent count guidance for the full year, right?
They did. That was the counterpoint. Full-year agent count now guided to 0% to plus 1.5% growth.
From what?
Up from -1% to plus 1% previously.
And that's driven by?
Primarily that strong international growth we saw in the first half, plus the stabilization signs they're seeing in the U.S. and Canada. So the network itself globally is still expected to grow.
Powerful underlying trend, even with the revenue headwinds.
Absolutely. So the core debate for investors now is, can these strategic bets, the AI referrals, Aspire international growth, scale up fast enough?
Fast enough to offset the softer cyclical revenue, especially in the U.S.
Exactly. And can they keep up that margin discipline? Those conversion wins like Hawaii become really important signals for whether they can eventually get a higher valuation multiple. It's a bet on execution through the cycle.
What an incredibly detailed look at RE/MAX's Q2. You see the strong earnings from cost control, but that revenue miss looms large. They're clearly building the global network, seeing maybe early positive signs in the U.S. stabilization, pushing tech, but the market remains tough.
It does. The big question for investors and for you listening is, how do you weigh these mixed signals? Internal strength versus external pressures.
How quickly can these new initiatives really move the needle on revenue? That seems key.
That's the multi-million-dollar question, isn't it?
So with all this laid out, let's pivot slightly. What does this mean for potential, let's say, interpretations or even trade ideas? Keeping in mind, of course, this is purely for discussion, not financial advice.
Right. Hypothetical scenarios based on the data. I'm intrigued. What have you got?
Okay, first idea. Thinking longer term, betting on their core strategy eventually working. I'd call it a patient growth bet with a safety net.
Okay.
So management's betting on the network, the agent growth, the tech paying off eventually, right? Even if monetization is slow now.
That's the narrative.
So instead of just buying the stock and hoping, maybe you look at buying their publicly traded debt. Gives you some stability, some income.
Bonds are safer.
But you pair that debt purchase with buying call options on the stock, maybe with a strike below the current price if possible, or near it. This creates a kind of synthetic convertible bond.
Right. Debt floor with equity upside.
Exactly. You get downside protection from the housing market messing things up further because you hold a debt, but you keep that potential upside if Aspire, the AI referrals, do eventually boost revenue per agent and the stock multiple expands. It's patient. It leverages the debt stability.
That's a measured, structure-based approach. Betting on the long game, mitigating risk. Okay, interesting. What's number two? More provocative, you said?
A bit more provocative, yeah. Let's call this one volatility fade and macro validation. Bit of a mouthful.
Okay, break it down.
2 parts. First, you could consider selling options, specifically a short straddle on RE/MAX, maybe with a near-term expiry.
Selling a straddle means you profit if the stock doesn't move much, right? Betting on low volatility.
Precisely. The idea is the market reacted sharply to the earnings miss and guidance cut. Maybe the initial shock is priced in now. Maybe the stock trades sideways for a bit. Selling the straddle lets you collect premium if that happens.
Okay, betting on stability after the storm. What's the second part?
Simultaneously, you take a long position in something like a regional bank ETF, one that's heavily exposed to mortgage origination.
So a completely different instrument. Why?
It's a macro hedge, but also a validation play. If those green shoots RE/MAX talked about rising inventory, more listings actually do translate into better housing conditions.
Then mortgage origination should pick up.
Right. And that regional bank ETF should benefit. So it validates the underlying market RE/MAX needs to thrive, even if RMAX stock itself hasn't fully re-rated yet, because their internal initiatives are still ramping up.
So you're capturing premium from expected RE/MAX stability short term, while betting directly on the housing recovery RE/MAX needs through a proxy.
Exactly. It's asymmetric, a bit contrarian. You're saying, okay, RMAX, I'll wait and see on your initiatives and collect premium while I wait, but you're also betting directly on the housing tailwinds they're hoping for, playing both sides of that cautiously optimistic stance.
That's definitely provocative. Combining a range-bound bet on the specific stock with a directional bet on the macro environment it depends on. Clever.
Just ideas to mull over. As we always say, this information is strictly for informational purposes. It is absolutely not financial advice.
Please do your own research. Consult with financial professionals before making any investment decisions.
So wrapping up our deep dive into RE/MAX Q2, strong earnings via costs, slight revenue miss, global agent growth, U.S. stabilization hopes, new tech.
All against a challenging but maybe slightly improving housing market backdrop. The key remains execution and the pace of translating initiatives into dollars.
What stands out most to you from this call? What connections are you making?
Keep exploring, keep questioning, always try to connect the dots.
Thanks for tuning in to the Deep Dive. We'll catch you on the next call.